Did you know there are many superannuation strategies that can cut your tax bill? They are not just for the wealthy or the elderly, that can suit a wide range of incomes and ages. And as we approach the end of the 2025 financial year, it's a perfect time to take actions. In this video, I'll walk you through 5 powerful superannuation strategies to help you legally reduce your tax bill in FY25. Let's get started. Strategy number 1, salary sacrifice. Salary sacrifice is an arrangement you make with your employer for them to direct part of your pre-tax salary into your superannuation. This reduces your taxable income and boosts your super in a more tax-effective way. Let's have a look at an example. John's taxable income in FY25 is $100,000. At a marginal tax rate of 30% plus a 2% Medicare levy, that's $22,788 in tax. So his take-home pay is $77,212. Now, let's say John decides to salary sacrifice $10,000 into his super. That means only $90,000 is taxed as income, and the $10,000 goes straight into super. On the $90,000, John pays $19,588 in tax, so his take-home pay drops to $70,412. The $10,000 that went into super is taxed at 15% inside super, so $1,500 goes to super contribution tax, and $8,500 ends up in his super account. So what does this mean for John? He pays $3,200 less in personal income tax. He saves $1,700 in total tax overall. That's personal tax plus super contribution tax. His take-home pay drops by $6,800, but his super grows by $8,500. But salary sacrifice does have a couple of limitations. One, not all employers offer it, so you'll need to check with yours. Second, since we are getting close to the end of the financial year, you might not have enough time to sacrifice the full amount you want. But don't worry, our next strategy, making a personal deductible super contribution, offers the same tax benefits of salary sacrifice without these limitations. Let's go back to John. Instead of involving his employer, John simply transfers $10,000 from his bank account directly into his super. Then he submits a notice of intent to claim a tax deduction to his super, and then receives acknowledgement from his super fund. That's the 3-step process for making a personal deductible super contribution. It offers the same tax benefits as salary sacrifice, just a different way of getting the money into super. If you're aged between 18 and 67, you are automatically eligible to use this strategy. If you are outside this age range, there are additional conditions, so make sure to check the ATO's website for full details. Before we go any further, there is one key rule you need to know: Concessional Contribution Cap. This is a maximum amount of before-tax contributions you can add to your super each year. There are 3 types of contributions that count towards this cap: employer contributions, salary sacrifice contributions, personal deductible contributions. For the current financial year FY25, the general concessional contribution cap is $30,000, and it will stay the same for the next financial year 2026. Most people are familiar with this cap, but this is just the general cap. You might actually be able to go over this $30,000 limit. And that brings us to the next strategy: carry forward concessional contribution. Here's the rule: if your total super balance is less than $500,000 as of 30th of June of the previous financial year, you may be able to contribute more than the general concessional contribution cap by using any unused cap amount from 5 previous financial years. In FY25, if your total super balance on 30th of June 2024 was less than $500,000, you can use any unused cap amount from FY20 to FY24. That means one can potentially contribute up to $162,500 and claim that as a tax deduction in FY25. That's 6 years worth of concessional contribution caps, 5 years of unused caps, plus the current year's cap. Unused cap amounts are applied automatically once you exceed your current year's general cap of 30,000. From there, the oldest available unused cap amounts are carried forward first. Importantly, as we enter the 2025-26 financial year, any unused concessional cap from 2019 and 20 will expire on 30th of June 2025. That means FY25 is your last chance to use any leftover amount from that financial year before it's gone for good. A good way to check your unused concessional contribution cap and total super balance is through MyGov ATO service. This strategy is very useful for someone who has a one-off high-income event, such as selling an investment property. Let's have a look at an example. Dennis is 60 and has been retired for 10 years. In FY25, he sold the investment property he had held for 5 years and made a capital gain of $370,150. He has no other income for the year. He qualifies for the 50% capital gains tax discount, reducing his taxable gain to $185,075. On that amount, he would owe $44,713 in personal income tax. Now let me show you how he can slash that tax bill by nearly half. Since Dennis hasn't made any super contributions for the past 5 years and his super balance on 30th of June 2024 was below 500,000, he can access unused concessional contribution caps from 5 previous years. This allows him to contribute and claim a tax deduction of up to $162,500. By doing this, he brings his taxable income down to just $22,575, which is the effective tax-free threshold for FY25. That means he pays 0 personal income tax. Instead, he pays 15% contribution tax inside super on the $162,500, which comes to $24,375. So by using the carry forward rule, Dennis saves $20,338 in tax. This just shows how powerful this strategy can be in the right situation. And even a less extreme application of this strategy can save a lot of tax. Strategy number 4, spouse super contribution. This is when one partner adds money to their spouse super account. This can boost the receiving spouse retirement savings while giving the contributing spouse a nice tax saving through a tax offset. The maximum tax offset the contributing partner can get is $540. This happens when the receiving spouse income is less than $37,000 and the contribution amount is at least $3,000. If the receiving spouse earns more, the tax benefit decreases until it cuts off once their income reaches $40,000. If the contribution is less than $3,000, the tax break also shrinks. If one partner in a couple earns less than $40,000, it's worthwhile looking into the details. I have made a dedicated video on this strategy, so feel free to check it out. Strategy number 5, government co-contribution. Government co-contribution doesn't give you free money on hand, but it's like free money for your super from the government if you meet certain eligibility criteria. For FY25, the maximum benefit is $500 contributed by the government to your super fund. If you make $1,000 after-tax non-concessional contribution to your super fund, and your income is under $45,400. The exact co-contribution amount depends on how much you contribute and your income. The government matches contributions at a rate of 50%. The maximum co-contribution of $500 gradually decreases and disappears when your income reaches $60,400, known as the higher income threshold or cutoff point. A commonly overlooked rule for government co-contributions is the 10% eligible income test. To qualify, at least 10% of your total income must come from employment or business activity, not just passive investment income. You can use the Super Co-Contribution Calculator on the ATO's website to estimate your co-contribution entitlement and eligibility. If you found these strategies helpful and want to learn more, make sure to check out my superannuation and retirement planning playlist. Thanks for watching. I'll see you in the next one.